In your wheelhouse, which is looking cross-asset, what I hear interview to interview is there's an oddness to this market. What's the oddness when you look at the coordination, the linkages between equities, bonds, currencies, and commodities?
I think probably the biggest oddness is just the resilience of the U.S. economy in the context of so much stress outside the U.S. and also the outperformance of U.S. assets. So there is going to be a time where there's a recoupling of these economies lower and the assets lower. I just don't think that time is now. It looks like from the latest data that we're getting out of Europe, it's looking like from the trajectory of trade policy in the U.S. that the stress is going to persist for a while longer.
John, for how much longer?
Well, we keep saying it's always going to turn in a quarter, and we keep pushing back that inflection point. So my guess is that if we had another quarter of lower PMIs, higher dollar, and also another quarter of profit warnings in the U.S., that would begin to really drive a more durable convergence. But I don't think that convergence is really happening right now.
Okay, I mean, is it 12 months away, 18 months away? Do you worry about an imminent U.S. recession?
No, not an imminent one. I think everyone has this idea in their head that 2 years from now the U.S. is going to be in a much worse place cyclically. But when you think about where rates are in the U.S., when you think about the impulse from fiscal stimulus, I don't think there's meaningful risk at all of a U.S. downturn in the next year.
But do you think that the Fed will be able to go through the hikes as expected, or will we see a little bit of a downturn in the U.S. economy, therefore tying the Fed's hands?
I think for sure the December hike is still highly likely, and I think actually the next 3 or 4 hikes are pretty likely. There's some concern short term that with markets moving lower, this is tightening financial conditions in an unwanted way, and this is going to deter the Fed from doing what it's planning to do in the dots. But when you look at how much financial conditions have moved over the year, I'd say they're net unchanged. They're not really tightening, and the economy still has a lot of momentum. So I don't really question the Fed outlook over the next few quarters at all.
I'm behind. I need an alpha build quickly into the end of the year. Where is the JPMorgan opportunity right now? Is it in foreign exchange, and if so, which pair provides me? Which pair is going to save my day?
Well, to me, the cyclical opportunity is still in equities. I do think the down move in stocks is excessive relative to the profits outlook over the next few quarters, relative to the run rate on the economy now and what's going to be delivered over the next few quarters. So I don't think there's any reason to really flinch from that opportunity. If you want to be defensive, I think that needs to be much more selective. I think it needs to be in currencies, and I think it needs to be specifically against Asian currencies, because that's the place where the growth concerns are going to persist for the longest.
If I want to be in equities, do I need to hedge? Do I need to do fancy stuff that JPMorgan offers to protect my backside if I want to stay in equities, or do you just buy U.S. equities?
I think you buy U.S. equities, but I think it needs to be somewhat less aggressive than one would have done 6 months ago, because we are at an inflection point in the profit cycle. So you want to be overweight equities versus bonds, but not to the extent that you were at the beginning of the year. You want to be in cyclicals, but not in every sector. You want to focus on tech, not the ones exposed to China, like materials and metals and mining stocks.